Good morning, good morning, good morning. How are we doing? What a funny week. What a funny month it's been. Oh, a little bit of feedback. Let me just turn that off. There we go. Right. Okay. So we are live. Let's get right into it. So we've just before we get into it, we've actually just had non-farm payrolls. So we've got a little bit of a live one going on. So we've just seen this huge reaction in the markets. I would imagine that we're going to see a little bit more downward movements. Most of the rally in the week, early in the week, for that matter, has pretty much been reclaimed. I would imagine it's all going to get reclaimed just with the way that the reaction has been. But we can talk a little bit more about that later. But yeah, just quite interesting to see the reaction. Positive data with non-farm payrolls, and we've had a negative reaction. Broad strokes reasoning is with positive employment figures, essentially. It's highlighting that the Fed policies aren't working, so that's why we've seen this negative reaction. Anyway, more on that later, just while we've got a little bit of a live one as we start the session. So let's find a dip worth buying. We pretty much have some version of this most weeks. I'm predominantly a trend trader. And if you're looking to find opportunities, buy dips, sell rallies, then you're in exactly the right place. I aim to try and profit from predominantly monthly and quarterly swings, although we have versions of the strategy that profit from daily and weekly swings in the markets. I'm a huge advocate of the fact that trading should be simple, it should work, and it should work not just for me. Obviously, I know what I'm doing. As I've taken on the role of an educator as well, it has to be replicatable. Otherwise, what's the point? What's the point of me doing this if you can't replicate something comparable? You won't get exactly the same. I'm not going to blow wind in anyone's sails. Legally, I can't say that either. But ultimately, you should be able to emulate or replicate your own measure of success. And I'm going to outline my number one money-making pattern, my number one and two, and I'll go through some of the others that I look at as well today. My mantra at the moment is I want to give you the right tools, the rules, the software to assist you, a community to support you, and a mentor to show you the right way so that you can get results. Why do I do this? I had no one to ask when I started out. I made every mistake that could be made. And over the years, people just kept asking me how I do what I do. And then we fast forward, more than 20 years on the education side of things, and we end up here together today. And on Fridays, I try and give back to the community at large. I appreciate that not everyone is in a position to afford my mentorship program or wants to afford that mentorship program. So I try and give it back in some small way so that you can at least get your foot on the path to success in trading. The first and probably the biggest lesson that I teach people is about the dip. Again, I am trend trading. And for most people, it doesn't mean what you think it means. Most people buy down days, down weeks, down months, and call it a dip. But without the qualifier of the trend, then it's meaningless. So I want to buy the dip in the context of a trend. A simple little qualifier actually makes a huge and significant improvement in performance because most people think they're buying dips and the reality is they're not. What I want to do as well, in addition to this, is I want to spend as little time doing this as possible. I don't want to sit here for any longer than I have to. Again, most people will also sit through or sit at the computer and pretty much flick through chart after chart after chart after chart after chart after chart like a mindless zombie, hoping to stumble across something, And a lot of this is caused by just not having a strategy, not having a clear and defined viewpoint on what you're looking for. So that's what we're going to dispel today. And again, no more will you have to do this drop-down analysis nonsense. I'm not an advocate of that either. You'll see in a moment that you can one time frame a strategy. It should be simple. And don't get me wrong, you can do this time frame, daily, weekly, monthly, triple time frame approach. It was written about by Van Tharp in the 80s or somewhere 30 years ago, whatever it was. It's not that it doesn't work. It's just that the trade-off is it's discretionary, it's time consuming. There's always going to be conflict. And if you're a new trader, having conflict between the timeframes, because again, the monthly could be pointing up and the daily could be pointing down. And you have this conflict between at least one of the timeframes. There's always going to be something different going on. And that creates a lot of confusion. Other things that cause confusion is just adding every tool and indicator on the charts. Let's just add another one and see if that helps. And again, it largely comes down to you're looking for something that works that you can profit from. But the reality is unless you know what you're looking for, then the tools to assist you, they're not going to make any sense. So I want to trade the trend. I want to buy dips and sell rallies. Again, 80 or so percent of the time, that's what I'm doing. So I'm going to use tools that supports me being able to buy the dips and sell the rallies. And similarly, if you're a counter trend trader, then you need to know what the trend is. You need to know when it's extended or overextended so that you can counter trend trade. And similarly, if you wanted to trade the range, you need to find non-trending markets and then apply suitable tools that are great, like oscillators, that would help support your range trading opportunities. Again, just trying to give you a few examples of, where you can easily make mistakes, but we don't want to add every indicator, the Dow theory, the GAN theory, the yellow wave theory, the MACD, the CCI, the RSI, the PPI. We don't want to do that just because, again, they're always going to be in conflict with each other. So we want the right tool for the right job. Again, if we're building a house, you're not going to bring every tool in the sheds to try and knock a nail in the wall. You're going to sensibly apply the right tool for the right job. Again, you're not going to use a screwdriver to hammer in nails. That's all we're trying to do. Again, it's common sense in the real world. All we're trying to do is apply the same common sense to our trading approach. And again, what we're trying to avoid, again, the last few slides, and then we'll move on to the charts. We want to try and avoid the habits and routines and processes that don't get results, because there's lots of things that don't get results. For example, over-analysis, we've just spoken about that. The make it up as you go along method, adding and removing indicators to see if it works. You keep adding and removing the indicators until it works, and you get, maybe one good day, one good trade, and then it fails. But we want an objective. We want a process. Again, if we were using the real world of business as a comparison, which this is a business, so we want to compare it to every other business that you're familiar with. If you tried selling fidget spinners on a Monday and, ladies' lingerie on a Tuesday and shoes on a Thursday, you're not going to have a successful business for very long. We want to have, one product range. And in the trading context, we want to have one tool, one objective, one time frame, and be a specialist rather than make it up every day and hope that it works. Neither do we want to fumble our entries. At the entries, the exits, the stops, the targets, we want to be able to find the optimal point. Again, it's an optimal point on average that we're looking for, not an optimal point every time. It's not going to be 100% successful. Just like if we had a real world business, you wouldn't expect a customer to come in every day and buy one of everything in every color and every size. There's also going to be customers that come in and ask for a refund. Maybe they bought the wrong size, it didn't fit, maybe it's defective. We take it for granted in the real world that you're not going to sell out of everything every day. There's going to be a little bit of give and take, but it's the on average return that we're looking for that creates a successful business. So again, we're trying to do the trading equivalents. Again, DIY, I've got to admit, this was the route that I took. It took a long time to make it work. Looking back on mine, almost 3 decades now, I do consider myself an anomaly. I wouldn't recommend this approach for anyone or most people. It's great to get you with some knowledge, the DIY routes, but it's difficult. It's hard work to make it work without support, without guidance, without following someone who's already broken a trail for you. So I would recommend everyone, whether it's me or someone else, I don't honestly care whether it's me or someone else. I'm not trying to, I'm a trader first and educator second, but if you want my help, it's there. But ultimately, someone who's going to guide you down the path to success in a process that makes sense for you. I can appreciate what I do isn't right for everyone. So find your person, find your guy, find your process, and get help. It's the fastest way to success. You do it in the real world of business. It makes sense. We hire consultants, we hire mentors, we hire agencies. It's the fastest path to success. Zombie trading, we've already spoken about. We don't want mediocre results. We don't want a YOLO to the moon. And I was mentioning this earlier, and someone pointed out or reminded me specifically of Wall Street Bets, because they were on there. And I just want to take a little bit of a detour to this insanity that can be called Wall Street Bets. It's on Reddit. It's a social media platform, but you can quite literally go into this channel, this social media thing, and just type loss porn inside Wall Street Bets, and you get people bragging about the losses that they're incurring. I mean, look at this. This is just from this month. You can go and fact check this. This isn't, me trying to, but this is what happens when you don't follow a process. Again, we've actually got a little bit of a montage here of the previous, all the previous months. I'm just going to skip through here. There's some of these are life-changing losses, like down $21,000. What do we got here? Down 34,000, down 34,000, 2,500, 3,000, 2,000. They're losing lots of money, 38,500. Again, I'm trying to highlight, 32,000. This is, it doesn't matter what your net worth is. These are painful losses that people incur because they don't know what they're doing. And they're just YOLOing, or you only live once, and essentially buying a lottery ticket and blaming it on something else other than themselves. Like, on that last one, I just called, China screwed me over with Alibaba. The reality is they've not got a process. And losing, again, money hand over fist. It is absolute insanity. So you don't have to take my word for it that it's out there, that this weird subculture of people bragging about the losses. I mean, I don't know about you, but I'm pretty, well off. But look at this one, just randomly paused this. Meme stocks. This is just from last month. What's that? $268,928 loss on what he's saying is meme stocks. And he's bragging about the loss that he's taken. How do you, honestly, how do you get that type of loss if you're not gambling? So that's really what I'm trying to get to. If you were doing it in the real world of business, then you would be laughed at, shouted at, mocked. I'm not saying it doesn't happen in the real world of business, but for most people with a little bit of common sense, you would go, of course, I'm not going to do that, because it would incur these horrible life-changing losses. So that's all I'm trying to get to with this, is have a process, have a mentor. Don't settle for mediocre. Find a process that fits for you. And you can avoid a lot of this heartache and problems and frustration. These conflicts they cause stress, second guessing, sleepless nights, anxiety. I know this firsthand, because early on in my career, I had a less robust, a less refined process. And I had the sleepless nights, I had the second guessing, I had the anxiety. But what happens over time, if you can get through that and you start to systematize, you start to refine, you start to processize what you're doing. Again, I refer to what I do these days as a production line process. It's methodical, mechanical, and it should be replicatable by anyone. And I wanted it for me first, because I didn't want the stress, the second guessing, anxiety, the sleepless nights. I wanted to stop asking the question of where's the trade, and having that where's Wally experience of constantly flicking through chart after chart after chart, hoping to find it, and move to making statements. There's the trade. That's what I'm looking for. There's the setup. Conditions have been met. Let's go. So that's what I'm trying to do in my own trading. And again, that creates certainty, peace of mind, it's consistent results. Of course, I get my own results. Broker statements are on the charts. Again, legally, I've got to say past performance, no guarantee of future performance. But again, just to try and illustrate that I practice what I preach. it should be replicatable. Again, my students get results, and that really is what matters to me as an educator, so that you can follow along and see your own measure of success. And later on, if you want to, you can work with me. Again, I'm not shy about inviting certain people to work with me. I'm very selective with who I work with and what I do, but nonetheless, you can, if you meet certain requirements, and you can learn my production line process, as I've mentioned. You can profit from monthly and quarterly swings. You can profit from weekly and fortnightly swings with a shorter term version of the strategy. We've got our S&P strategy, which ideally catches one trade a day when markets are trending. And it's been a little bit flat this past 6 to 8 weeks because the market's not really trending in any significant direction. But as soon as that kicks in, then we'll be back-to-back profits on there. We can also trade the opening bell on stocks. I don't do this much very often. Again, the trade-off is time at the screen. But for those who do have a little bit more time to do this, then you can trade the opening bell. The way that we've designed this strategy is you'll know yesterday if there is a trade for today, essentially, or you'll know if today there's a trade for tomorrow. So you'll have a lot of advanced warning as to what the potential for a move is. And obviously, we can trade the ranges. We're going to speak about some of these patterns today in the main part of the show. Before we do get into it, just in case you are new and you're wondering who this weird guy with a funny accent is, my name's Phil Newton. I like weird shits, like flamingos. I don't know why. I've all got a weird, quirky thing. That's mine. I like coffee, good walks. I like to spend time away from the computer as much as possible. When I do spend time at the computer, I get to do wonderful things like these open sessions and help traders guide them down and get their own version of success. I've been trading since the mid-90s, almost 30 years at it. And for the last 22, 23 years, helping good people like you become great traders. And again, I've got to say, I am not a Wall Street guru. I'm not a financial advisor. You should most definitely not listen to anything I say and consider it financial advice. It's just my opinion of what I've found works for me. Again, past performance, no guarantee of future performance. And what you will see, though, is that it does sing from the same song sheets. There are certain footprints that we can identify. And that essentially allows me to be just a regular guy trying to do some nice things on a Friday with some lovely people. And then I can go and enjoy my weekend as well. So that's it. That's my who I am. And with that said, let's go and hit the charts. I've got the chat boxes open on both the YouTubes. Hello, if you're watching on YouTube, smash the like button. If you're watching, leave a comment. If you're also wanting to have a look at or you want me to review some individual stocks. Just get the YouTube comments. There we go. Got that. And we've got the Zoom. If you're watching this on Zoom, hello, you lovely Zoom people. Stalling for a moment while I'm just checking that everything's doing what it's supposed to do. Right, let's hit the charts. So, quick slurp of my tea. Oh, I made coffee. Completely forgot. So there we go. Oh, I was expecting tea. I'm going to mouthful of coffee. Right, let's start, as always, with the strategy. Again, I usually like to review the strategy at least once a month. I've done this with my insiders, and obviously you're going to get the back of the envelope version. That would be rude of me to reveal all my secrets. I'm sorry, but I'll give you as much as you can today to make it work for you. And obviously there's some specifics that would be impractical of me to mention, just because there is obviously people who pay to work more closely with me. So what we're going to do is we're going to look at how to identify a trend. That's the most important part. Is this a trending chart? And can we profit from it? That's my number one money-making pattern. I'm just winding it back because it's easier to go through the bullish side. I'll go through the bearish side, so you'll have my number one and number two money-making patterns. And then we'll go and look at the other four actually today. So you can find out if market is trending or ranging, and then you can choose the appropriate way to trade the market. Again, we've got to identify trends first. Again, if the market is trending, we apply trending strategies. If the market is ranging, we apply ranging tactics. So I use moving averages in both cases. Let me just change my color. Moving averages in both cases. We've got the 200 period moving average right there. We've got the 50 period moving average right there. And the third line is the 20 period moving average. So I want to see the 50 above the 200. The crossover is how it's phrased. This is referred to sometimes as a golden cross. Don't roll your eyes at me. I didn't make the name. Someone wrote about it many, many years ago and labeled it some bullshit name, but there we go. So it's golden cross. At this point, I'm going to say I'm only looking for bullish setups on this chart. Not the market. I can appreciate we're looking at the S&P, but I will trade both sides, and I trade every stock or opportunity that I look at independently from each other. We just happen to be looking at the S&P, the market. It is tradable, but this is what I refer to now as a bullish direction. We've also got the 20-period moving average on here. That is used, but just for simplicity, I'm going to focus on the 50 and the 200. But we can add in using the same process that I'm going to mention with the 20-period moving average as well. Essentially, what we want to see is these moving averages stacked. Initially, we've got the crossover right there, and then we want to see price push away. You're never going to capture that first push. Don't worry about it. There is a way that we can do it, but again, it's not often not worth it. But nonetheless, we want to see the crossover. We want to see the moving averages stacked, and then we can start saying, okay, well, now we've got our direction. The downward movements can be considered dips in the context of a trend. And I'm adding that qualifier intentionally. Most people would just say it's a dip. Buy the dip, baby, buy the dip. Hashtag BTFD. Well, without a trend, there's no dip. So what we've just done is added the qualifier of what we consider to be a trend. Therefore, we can find dips. Now what we want to do is find a dip worth buying. So I want to see price push lower and then come below. Again, I'm just going to focus on the 50-period moving average. We can do the same with the 20. But when price comes back to the 50-period moving average, I'm just highlighting these areas right now. When it comes back to the 50, it filters out all the down days, the down weeks, and sometimes the down months. And it just makes it so we have the dips that are deep enough that are worth buying. So we've got several all the way through 2020 and 2021. That's this range on the charts, the date range. But we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 that we can see on the charts all the way through the end of 2020 and into the end of 2020. So about 15 months. So there's lots of opportunities. And what you're hopefully starting to see is when you have a trend, it's often long lasting. So again, don't worry about the very start of the potential movements. But when there's a good solid trend, it often lasts for many, many months, several months, 12 months, 50 months in this case, sometimes 2, 3, 4, 5 years. So we can have a lot of opportunity. But what we've just done is we figured out, okay, well, there's the trend, average price crossover, bullish direction, and then we've got dips worth buying. So when price comes back below the 50, that's when I'm going to say, okay, well, this is when I'm interested. But it's as it pushes back away, that's the bit that I'm going to profit from. So it comes back away, and as it comes back to between the moving averages, that's the bit that we want to profit from. So it pushes away, back to, that's the bit that we can profit from. Away and back to, just a little one there, that's the bit we can profit from. Away and back to, that's the bit that we can profit from. Away and back to, just a tiny one there. Away and back to, that's the bit we can profit from. Now this one, it does it, but this is a monetary loss. It's not a losing trade. We're going to take it anyway, but that is one that would have appreciated a monetary loss. Oh, actually, my apologies. There is a little one there that I just overlooked. I knew there was 2 on this chart, so there's one there. So we've got lots of opportunity, and then the last one right there, we've got a nice profit one. So we've got 1, 2, 3, 4, 5, 6, 7, 8, 9. We've got 10 trades. That 10th one is also just a little tiny one there, losing trades. So I think we can see that we've got 10 trades on the dance card, as it were, on the trend, and 3 of those are losing money. It's not a losing trade because it meets the criteria for dip buying. It's just that, hey, this is one that would have lost his money on average. Call it a customer refunds, to use our metaphor from earlier. Customer came in, bought the wrong size, returned it, got a refund. You know, that's what we're doing here. It's the stock market equivalent of, okay, well, we need to give the market a tiny refund. But we got 3 trades out of 10. And obviously that means that 7 of them in those 15 months worked out just fine. Isn't that good? So what's that? Just on this area of the charts, we've got a 70% success rate. It averages out, again, if you look back over 20 or so years, it actually works out at about, I think we'll look at the stats actually, about 52%. So this is just in that 12-month period. Obviously, it's a little bit of an anomaly. It's post-COVID, everything was going up, so easy to have an anomaly. So that number, don't marry to it, it's just an anomaly. But if you look back over 20 years, you should be looking at about 52, 53, 54% of the time, it is making money, and it's making more money than losers. That's all that matters. You don't actually need a 50% success rate. You can realistically go down to a 30% success rate. If you think about, to use a baseball, I'm going to attempt a sporting metaphor, forgive me. I'm not into my sport, but if you think about the sporting metaphor, is it baseball? If you've got a point, is it 0.3 or 30% success rate of hitting the ball, you're doing pretty well. You don't need a high success rate. It's all I'm saying. A win rate is something that people latch onto as being the be all and end all for a strategy performance, but you don't actually have to be successful a lot of the time. Does the strategy make money? Yes or no? That's really more important for me. So let's just click the magic button. If we bought the dips and sold the rallies in the way that I've just described, buy the dips and sell the rallies, what we're looking at is a strategy performance report that says in the last 20 years, there's the date right there. If I bought the dips and sold the rallies, I didn't think, I didn't deviate, I didn't question, I didn't second guess, I didn't analyze, didn't do trend lines, I didn't look at who's tweeting what, I didn't care about the Fed, interest rates, didn't care about market reports. If I just bought dips and sold rallies, didn't look at anything else in the outside world, this is the equity curve that would have been achieved. So what I'm trying to illustrate is a positive expectation of the strategy. Does the strategy work as we expected? Yes, and it would have yielded a profitable result. Great. That means that it should have the, or I should have the confidence to do it again today, tomorrow, next week, next month, next year, and for the next 10 years, for all I care, because we've got a positive expectancy strategy. This is what a validate or strategy validation looks like for me. Now, let's go and take a look at the bear side. So again, we've talked about buying dips. Let's just quickly look at selling rallies. And you'll have two of my money-making patterns. So average, so there's the 200, there's the 50, it goes below. So they've got the crossover. This one's called a, what's called a death cross. Again, don't roll your eyes at me. I didn't call them that, but that's it. So what we want to see, we've got the average prices crossed over. You want to see price push away. So it wasn't really until about April, May that we had the bear confirmed, but you've got that last monetary loss there. There's actually one tiny profit there. But as price transitions, the strategy keeps you in cash as it transitions, which it did here. Then it pushes away, and then you can start selling rallies in a downtrend. So you got your profitable trade there, you got the huge rally, and then the profitable bit right there. So you've got the opportunity to sell rallies in a downtrend. Again, just two trades going off right there. Bear trends last a little bit less in time duration, but they can last, again, months, years on the bear side there. But ultimately, they don't typically have as longer lasting duration as we do see on the bull side. Again, it's just the nature of the markets. But it looks like what we've got right now is a very similar unfolding to what we saw. So we got this, 20% rally here. It looks like we've got something similar, this 20% rally here. So this is the last bastion, just as we had here when we spoke about it in middle August. Looking at right now, we've got that last bastion. We've got the 200-period moving average being challenged. I have drawn some trend lines on because obviously we can connect the dots. So it's not necessarily essential to the process, but I like to layer on my own knowledge and experience from time to time. It's an occasional thing, as we know, but ultimately we've got a similar look to the charts as we have back in August. And this is the last chance for the bears, essentially. So if there's going to be further bearish movements, then this is where we will see the potential downturn in the markets. Otherwise, we've got this bullish expectation. We'll have a breakout through the trend line. We'll be back above the 200-period moving average. And that's that transition, just like we saw over here. that'd be that transition. You saw the opposite happen. You had, bullish trend lines. If you were drawing them, you've got this transition as price goes below the 200-period moving average. It might dick around for a while, and then you get the trend. So we might see that happen over here. So, but this is that potential first indication that we're transitioning from a bearish trend as per the description, the definitions that we use, and transitioning over to a bullish directional bias. Again, there's going to be a little bit of a transition period before a new trade is placed, but ultimately it's looking like we're at that potential location for a turn. On a personal note, I don't think we're there yet. I think there's going to be a little bit more hardships to see before we actually see things turn around. Again, that is an opinion. I'm not going to trade that, but I am just putting it out there nonetheless. I am a little bit bearish still for the moment. One of the reasons for me being bearish, if I just go over to a different viewpoint, one of the things that we do like to look at, and this is a new thing in the last 6 months. This is still the S&P 500. What I've got in addition to that is the number of stocks on the S&P 500 that are above or below the 20-period moving average. Again, nothing magical about this. It's just a graphical representation of the number of stocks above or below. There's 500 or so stocks, excuse me, 500 stocks on the S&P 500. And what we're looking at here is that they're around 80 to 90% of the S&P 500 stocks are above the 20-period moving average. That's all we're looking at here. So we've got a broad market rally in a downtrend. Now, what you will see is when that happens, we have this ability to say, okay, well, the market is overextended. The markets as a whole is overextended. And I'm just highlighting the last, or this year's, or the year's times where that's happened. And we can see that when it does happen, there's often a turn to be anticipated. The last time we were overextended back in August, we had this, what I refer to as a bullish extreme for several weeks. We've got that right now. So we have this bullish extreme back in July, August. And again, right now, we've got this bullish extreme right now. And again, really, we need to see it tip over. We need to see price push down, because often what we will see is a little bit of a sell-off, So what we see is a little bit of a sell-off, So I'm still in the short term anticipating a sell-off. So that's what it comes down to. So I'm still a little bit bearish in the short term. Where could it get to? Again, I'm not really expecting a huge move to the downside, but I have been talking about this for a while. Somewhere around 3,800 seems sensible to me, just that next level of support. If we get a bigger move like we saw back in June, if we get a bigger move like we saw back in August, September, I'm not going to say no to that. I'd be happy with it on a personal level. Again, broad strokes, it's nice to have an opinion. It's nice to have it fulfilled, but I'm positioned for a bullish move or a bearish move. So it doesn't really matter which way the market goes for me, but I just like the analysis to come to fruition. Essentially, we've got this expectation. We've got a tool that we use to give us these bullish and bearish indications. And right now we've got a bullish extreme. In the short term, I'm expecting or anticipating at least a small down move in the markets, which may happen in the first 2 weeks of December. Why the first 2 weeks of December? I'm glad you asked me that. Let's go and look at 2018. In fact, now I've not got enough data on that chart. Let's go back to this one. So let's go back to 2018. Why am I thinking that there's going to be a down move in the first 2 weeks of December? Let's just zoom in slightly. So one of the things that we've been talking about the last couple of weeks is how similar. Yes, absolutely, Brett. Here comes Santa Claus. One of the things that we have noted several times, again, this is 2018, is how similar that 2018 is similar in its footprint to this year, 2022. At the beginning of the year, now on the broad market, we didn't have the big move. So we've got a big move at the beginning of the year. This was a flash crash, February, March in 2018. We actually had a big move on the bull side on the energy sector. So we saw a big move at the beginning of the year. Again, doesn't have to be bullish, doesn't have to be bearish. I'm just trying to identify the footprints. Big move at the beginning of the year. It was focused in the energy sector, I'm sure, for obvious reasons for most people. So I'll just forego any explanation there. We have had sessions on that in the past. But ultimately, big move at the beginning of the year. The main body of the year, all the way up to right now-ish, November, December, it's kind of grinded sideways. I mean, if we look at the height of the bars from April onwards, so April's right there, just as I'm noodling on the charts, but the height of the bars, the green and the red bars, very narrow now, very tight, very shallow movements. And then we get the end of the year. Again, the consolidation right now is what we see in November, December. And then as we come into December, we had this flash crash, another flash crash, and it turned, in fairness, what was just a year I was waiting to wash my hands of. It was not a horrible year. It was just nothing exciting. The individual stocks, the swings were lackluster. There was no oomph in the moves. When there was a move, it was very short-lived. And that I could be talking about this year. It's not that there's not been movement, it's that when something does move, when it has moved, it's been quick, it's been short-lived. The trends have been very lackluster. If you look at any of the industry reports, there's a lot of people, a lot of hedge funds, banks, institutions that are sitting on cash. There's nothing really sloshing around in the markets to create the trends. Because again, the banks, the institutions, the hedge funds, they create the moves, and there's just no real moves. So we've got that same lackluster year, and then all the move happened in December. To be fair, in 10 days in December, the first couple of weeks or first 2 weeks of December, we saw again another flash crash. So again, a big move at the end of the year. Again, bullish or bearish, I don't really mind, but hopefully it just influences we've got the potential for a good move prior to the end of the year, because the reason why I like doing this kind of analysis, spot the difference analysis I call, we've got a completed picture in the form of 2018. And the footprints, the way that the market has unfolded is almost a carbon copy of this year. Again, let's go through and compare it to this year. Visually, it's going to look different, but let's consider the footprints at the beginning of the year. So again, there's the 2022, the beginning of the year is right there. Now, it wasn't massive, but there was a good move on the bear side there in the energy sector. At the beginning of the year, we had this huge bullish uptrend. So we've got a similar footprint to the start. We had big move at the beginning of the year. Visually, not a huge one on the S&P, the index, but again, in the energy sector, huge move on the bull side and a moderate move, in fairness. Now we're looking at it on the bear side, very similar to 2018. Again, most of the year, from March onwards, was very lackluster. There wasn't that much excitement. Again, that there is movement, as we can see, just like we saw in 2018, but the moves very short-lived, 2, 3, 4 days, and then the markets would stop. On individual stocks, it's been very similar. We've seen good moves. They have been there, but they've been very short-lived, and many weeks of nothing, big move, then nothing, and that's what we've seen for most of this year. So as we come into the end of the year, we saw a consolidation at the end of 2018. What do we see right now? Well, it's angled, but we've got a nice compact contraction of price behavior. And sorry, the middle of the year, again, we've got a lackluster movements, but it's still a narrow band of trading activity. Again, it's not horizontal. This one's angled. So again, the footprint is similar. Again, visually, it doesn't look the same, but the footprint is most of the year very lackluster. We know that it's consolidating because we've got multiple crosses in our average price. That's one of the cues that we use to identify such things. The only way that the average prices can flip and flop is if prices can narrow band of activity. Another way of saying that is a consolidation. In this case, we can put trend lines around it and call it a channel. Again, coming back to the end of the right now, the last couple of months, it's a similar thing here. We've got an even tighter band of trading activity. We've got, with a straight line ruler, aka the trend line, we can connect the highs and call this a rising channel, connect the lows, we can call this a rising channel. So we've got this narrow band of trading activity, very similar to what we saw at the end of 2018. So as we're thinking about what next, Again, bullish or bearish, I don't really mind, but I'm anticipating a big move into the end of the year. Now, because December is a shortened month, hopefully for obvious reasons, we have in the Western world, we have Christmas holidays, festive holidays, essentially. The market's essentially going to be not necessarily closed, but they'll be on skeleton crew, essentially, in the last 2 weeks of the year. So if there's going to be any interesting movements, it's going to be in these next 2 weeks, and if there is, it usually is quite an interesting movements. That's the way that I phrase big move in a short space of time. Again, bullish move, I don't really mind. Bearish move, I don't really mind. I'm positioned for either outcome on the portfolio. I've got a number of bullish stocks, I've got a number of bearish stocks. Again, in the short term, I am bearish. We could see a down move for 3, 4, 5 days. It won't take much to get back to price support, and if there is going to be a bullish move, then we can see it then. Again, I don't really mind on the direction, but I'm just anticipating a big move. Other things that we can consider. One of the things that we spoke about a couple of weeks ago, in the big scheme of thing going into the end of the year and into the beginning of next year, we can still see both the bearish move and the bullish move happen. The bullish move is one I'm about to explain. The bearish move in the short term is a possibility. So we can see a short-term down move and a longer-term bullish move. Why am I talking about a bullish move? Well, one of the things that we spoke about several weeks ago now is the cyclical nature of the markets. Post midterms, we generally see a bullish move. We're also generally see December as mostly bullish going into the end of the year. Some people call that the Santa rally. There's a little bit of confusion and misconceptions around the Santa rally. It's actually the 4 days between Christmas and New Year, or the last 5 days of the month. Depends on how the days and how Christmas falls, but it's that last 5 days, and it's such a short window, and there's often not that much movement, but it's generally bullish during that time period, is the reality of that. Most people think of December as the Santa Claus rally or the Santa Claus month. Again, broadly speaking, the October to the end of the year period, the last quarter of the year, is often quite bullish, but it's not the Santa Claus rally. It's actually those 5 days between Christmas and New Year, the last 5 days of the month, essentially. Anyway, just a little bit of a random sidebar. Hopefully that just adds a little bit of extra dimension. With that in mind, those 5 days, they're often not tradable. They're generally positive, usually in the low single-digit percentages, 3-4. I think it's 3-4% from memory. It's just not worth trading. But it does happen, and the media latches onto it for whatever bullshit reason that they want, because it's a slow news week. Anyway, where were we? Oh, yeah. So we've got 2018 looking, the footprint, the ebbs and flows of the market, very similar to this year so far. And it just gets me thinking that maybe because we've seen such a lackluster year, mediocre movements, maybe we will see a big move in a short space of time over the next 2 weeks. So that's where I'm at with that hypothesis. Right, let me just pause there, actually. Any questions, any comments, anything you want to add to that analysis over what may be happening and how this year, again, with quite literally 4 weeks left to the year, it's looking very similar to 2018. And it just gets me thinking that if we're going to see something, it's going to be in the next 1 to 2 weeks. I don't think so. I mean, one of the things, Brett, so Brett's just asking, are they going to pivot the Fed? I doubt it as well. We've just seen non-farm payrolls released, which, if you're not familiar with it, here's the 2-minute chart of the S&P. So what we've just seen is almost a complete straight line down movements. Again, if we look at the 60-minute charts, giving back the gains that we saw early in the week, almost, just eyeballing it, what's that, about 60%? About 60% of the move it's given back that we saw early in the week. Why did it happen? So we had a positive non-farm payroll. So basically the employment reports. Again, I've not seen the reports. I'm just guessing based on the way that prices behaved. So as I understand, it's been a positive non-farm payroll reports, meaning that more people have got jobs, which is great on one hand. But the reality is what the Fed is trying to do is they're putting measures in place to actually create unemployment. So because there's been a positive non-farm payroll figure, an employment figure at reports, that's been seen as negative on, it's been negative on, or it's been seen by negative on the markets, because it means that the Fed's nonsense essentially is not working in the way that, or at least not yet. And that might mean that their their 0.75 basis point hikes might still happen, because earlier in the week they said that they're probably not going to do the big interest rate hikes again, and the market went crazy for it. But the reality is that the employment is not being stemmed. As Brett said, it's not cooling the economy. And just to swipe your phrase, I like that. It's not cooling the economy in the way that they would have wanted for all their fiscal measures to work out the way that they have told us. So maybe there's going to be some more painful rate hikes to try and get on track. We'll find out at the next meeting. So that's what it means for the economy. So as we're looking at this, we've got a huge sell-off. Looks like we've had, again, on the 2-minute chart, looks like a little bit of 50% rally. Interestingly, back into the moving averages on the 2-minute charts. We've got this lovely break of this 2-minute range, breakout, pull back into the 50-period moving average. Retest of the lows would be where I'd be thinking if I was just scalping this. May have a little go at this later. But yeah, the same principle should be working on the 2-minute charts. So yeah, we're just not. So are we going to see the pivots and the cooling of all the measures? Probably not, as evidenced by the reaction to non-farm payrolls. The measures are not working, at least not yet. I'm sure that they will, but it might just mean that there's some more hard times ahead. Again, on a personal note, I don't think we've seen the worst of it. I think we've got an actual recession to come. I think we're going to see certainly the first half of next year as tough measures, tough love. We're going to see more downward movements. Again, I'm going to look back at history. The reason why I like doing this is history repeats itself, constantly repeats itself. You've only got to look at the charts. I'm going to go back to 2001, 2002. Appreciate we had a market crash post.com boubelle. I don't know why I said it like that, folks. Bear with me. But we've got this, again, 2001. History repeats. Why do I keep saying history repeats itself? History repeats itself because the charts are a visual representation of crowd psychology. And crowd psychology hasn't changed in hundreds, if not, thousands of years. We behave at a base level in very similar ways to what we have done for hundreds and hundreds of years. So that's why I keep saying that we can look at history and find similar footprints. It's not going to be exactly the same. Visually, it may not unfold in exactly the same way, but we've got this, again, this visual representation of crowd psychology, and the crowd behaves in weird ass shitty ways. Anyway, absolutely, Brett. Yeah, no, I completely agree. So we've got, so what have we got? 2000, 2001. We've got so there's 2001. I can assure you it was not a space odyssey. So the crossover, you've got the bears as first rally, big push trend, second rally. That looks like July, August this year, where you had that first 20% rally. That's why I've got it marked off. So July, again, just comparing it to this year. So July 22 is very similar to what we just saw there. We didn't see the meandering sideways. We pretty much saw price do that part straight off. So again, if you look at the months, it's very similar to what we've just been talking about. 2000. Let's compare 2001 to where's my drawing widgets? 2000 compared to 2018. Big move at the beginning of the year to the downside. Nothing going on in the middle of the year. Big move at the end of the year. It's unsurprising that these things happen. When you point these things out and you don't marry yourself to it. I can't overlay one year with the next and it looks exactly the same. It's going to be slightly different, if not completely different. But if you look at the footprints, big move, no move, big move. Let's go on to 2002. So 2002 was the potential start of the recovery, which is what everyone's thinking right now. So September, here's the rally now as we're coming into the end of the year. You've got that end of the so it's 2002, and it's the moving averages start to compress. You've got that consolidation, and then you get this retest of the lows. It actually goes a little bit lower. But you get this, essential retest. And this is normally how a recovery goes. So if we are going to see bull markets, a transition to a bull market, we need this type of pattern to happen, because that's normally how markets recover. but we're not there yet. We've not had, we've had so many changing of the definitions of recession and bear economy, and we're in global recession, it's yet to come to some sort of fruition. So as you come into, again, coming back into, this is what I think will happen next, this next part. So now we're into 2002, there's August. So you've got that consolidation, the double bottom failed, and that's the bit that I think is going to happen going into 2023. Does that make sense? So I just think the maybe not as dramatic and that big. Again, I wouldn't, it's almost a crash there. I wouldn't want another market crash, but I think there's more bearish movements. Yeah, I think, again, I'm trying to emphasize it's not critical to the strategy, but you've got to look at history to find out what to expect, what could be anticipated next. Again, from a portfolio point of view, I've got bullish exposure, I've got bear exposure. The reality is I don't really care which way it goes as long as it does go, as long as it moves. But at the same time, maybe I can take advantage of the viewpoint. I can layer on the analysis. I've got 30 years experience reading the charts and trading. Maybe I can take advantage of it. So when that down move potentially happens, maybe I can take advantage of it by increasing my position size on the bear side. But it's not going to catch me on the wrong foot if or when it happens, because I've thought about it as a possibility. And similarly, if the bull side happens, well, maybe I don't increase my position side on the bull side because I don't think we're going to see a sustained bullish movements. So I can take advantage of it that way, but I'll still profit from a bullish movement. I'm not trading it if it does go up or individual stocks go up. It's just I'm trying to be sensible with my understanding of the chart. So that's the bit that I think is going to happen next. And again, if we come back to market recoveries, they take time. If you think about market recoveries, and again, I apologize, none of this is what I was intending on talking about, but it's an interesting discussion in real time, which is important. If we just wind forward, so here again, coming back, so we're back into the end of 2002 there, and this is 2003. So again, this is normally what happens. So there's that rally. Huge bear market rallies happen in bear markets. 25-30% is not uncommon to see. The retest of the low is what you would normally see. You can call that a double bottom. And then what normally happens is this sideways transition, this accumulation and distribution phase. You've seen the imbalance in supply and demand, which is a trend. You've got the distribution of the bear profits, the accumulation of the bullish side of the ledger. These things take time. If you imagine this as an ocean liner trying to turn around in a canal, it takes time, multiple point turns to eventually take off. And eventually we'll get our average price crossover. That's how we normally do it. That's our first sign. Wait for it to push away, catch the first dip in the context of a trend. Technically, this could also be interpreted as a breakout and a pullback. We'll always catch it with our interpretation and the way that we use moving averages. But again, the point I'm getting to is market bottoms happen over an extended period of time. There's one exception to this, which caught everyone on the wrong foot, including me. I got spanked. I've spoken about that at length in the past. And that was the recent COVID crash. I rode that bugger all the way down, shouting, yeehaw, riding cowboy all the way. Absolutely COVID. Rode that bad boy all the way down. And because I was expecting this double bottom, a little bit of sideways and then the recovery, I filled my boots there, expecting at least some type of downward movement, maybe not all the way in an actual double bottom, but just a retest. If I can get halfway, I was thinking this is going to be amazing. And I got kicked in the shins because it did this fucking V recovery. And it's unusual for it to happen. But if we think about it, it was artificial. It was stimulated. There was huge money pumped into it. Was just... So it took a while to turn that ship around for my own personal ocean liner rounds. But yeah, by the end of the year, it was turned around and we were back to scratch for the year and, making money, and everyone's fine and dandy. So anyway, a point is, you go back through history. Don't take my word for it. Look at all the market bottoms, or look at all the bear markets. And the footprint is similar, very similar. Again, the one exception, as we just said, is the COVID exception. But most of the time, this is what happens in a market bottom. A natural, unmanipulated, no QE, market bottom, market recovery. It's this accumulation and distribution that unfolds, and it's usually something that happens over many, many months. Usually 6 to 8 months is what normally happens, and then obviously we know what happened next. The bull markets resumes. Interestingly, it always happens on the average prices crossing over. So anyway, that's where we're at. So our average prices. So there's the two. So we're back to present day, back to the future. Doc Brown in his DeLorean. There's the 50, there's the 200, there's the 50-period moving average. That's got a long way to go before it crosses over, and we can start calling it our bullish crossover. It's going to take time to unfold. So again, I'm not convinced with the bullish market. We may see a bullish movement. We're already seeing movements past the 200-period moving average on the Dow. Bear in mind, that's only 30 stocks, so it's not hard for one stock or two, 3 stocks to kind of push that index around. And the NASDAQ 100 stocks is representative of the index. Let's actually go and look at them, and that'll be a great place to finish, just so we can see. So the S&P is a representation of 500 stocks. Generally why I look at that, because it's got a large number of stocks. The Dow is one of the ones that has booked the trend for what a better reason. It is above the 200-period moving average. It is pushing high. Again, personally, I'm not convinced, at least not yet. Need to see the average prices cross over. They're not there yet. Again, NASDAQ is a long way away. It's not even back by comparison. It's just not participated in the rally. Not unsurprising. All the high beta, all the tech stocks, they're all down significantly off their highs. So again, it's just not participated in this rally at all. Let's take a look at Russell. Russell's always interesting. You've got the lower cap or mid cap, lower cap, 2,000 stocks, more of a smoothed index. This is probably a more accurate representation of what I refer to as the economy. Again, I appreciate the stock market is not the actual economy. It's just a representation, but you've got that sideways movement there. You've almost got the double bottom that we were just talking about there. But if we think about 2001, it's not participating in the rally. Could this be a lower high? Could we see price push down and retest? You could argue that you've got this descending triangle if you want to put a label on it. So it'll be interesting to see if that actually unfolds in the way that we see if that unfolds in the way that we think, and the bear movement continues. But again, I just don't see the bullish hypothesis unfolding yet. I'd love to be bullish. I truly would. And I've said to some of my insiders, I want to be bullish. I'd love to, see things turn around. But the reality is, until we see the usual hallmarks that we see from going from a bear market to a bull market, it's unlikely that we'll get what we want. Anything is just opinion. You can look at, again, I've mentioned my opinion several times to try to emphasize what my opinion is, but the facts are we've not seen our usual hallmarks from a transition from a bear movement to a bullish movement. Again, you don't have to take my word for it. We've just got to look back at several transitions and what it looks like. And it's just not there yet. So I have a hard job being convinced that the bull is in town. And yeah, the bull move is happening, but you always see huge bullish movements. Massive, but I mean, that one was 20%. Visually, this look, what have we got, 36? Yeah, it's about that the same. We're almost there. You see these huge bull movements in bear markets. And again, we're just not there yet. Again, I can't say it will, that this... It's not impossible for this to be the bottom, and we will see things turn around as we saw with the COVID recovery. But we're not seeing the same manipulation of the markets. The Fed's certainly not printing cash. The central banks around the world are not printing cash. We're not seeing the same thing. So the situation for the moment is different. And as things start to unfold for us, then we're going to be looking for those hallmarks. Go back to 2000, 2001, 2002, and you'll see the recovery. And the reason why I'm using that one over 2008, just for reference, is there was a quantitative easing in 2008. The printing presses got rolling. So you had that recovery manipulated. It still unfolded in a similar way, but there was still that artificial element to it. So that's why I keep going back to 2001, 2002 to assess the recovery as a more natural market reaction. Absolutely, yeah, that's a good comment. Yeah, you're going to see a stampede or two, but you're not going to see the herds change direction. That's a good way of doing it. All right, folks, I think that's all we've got time for. Well, let's just check the questions. Any questions, comments, anything you want me to review very quickly before we hang our spurs up for the session? Again, I'm not seeing anything on the YouTubes. Hello on YouTube. If you're watching, pop a like and a comment. If you're on the Zooms, pop a comment in the chat. Where's me? There we go. Right. So we've chased a few squirrels today, haven't we? There's my favorite squirrel photo. Cheers, Brett. I appreciate the comment. Brett was just saying, love the quick fire round on the reads. Should do at the end of every Friday. Yeah, I should do. Yeah. Well, that was one of, I find that I sometimes worry, Brett, that I say the same thing. I'm very conscious that I repeat myself frequently. But there's only so many ways that you can say buy the dip and sell the rally before people start believing me. So it's like, from my point of view, it's a little bit redundant. But yes, we did go a little bit off-piste and have a more discretionary assessment this time. Yeah. Bang that drum. I like it. Oh, cheers. Thank you very much. Right, thinking about doing the same things. If you don't change, nothing will change. You don't change, nothing will change. One of the things that I did very early on in my own development as a trainer, again, keep in mind, I did it the hard way. I didn't know I was doing it the hard way. It was just that for me, that was the only way. But I just didn't know. I started out pre-internet in my training, as most of you probably have done as well. But I didn't know that you could find mentors. Again, the internet wasn't really a thing. But it was just that personal journey. So what I was trying to figure out was, if I'd had what I considered to be a bad trade or a bad day or a bad experience, I was very consciously trying to, how can I not do that again, was the approach that I took in my own trade. How can I not do that again? And it's an interesting way. So if you want DIY, again, I'm not saying you can't do it. You can do it. It's just, it's hard work. It takes efforts. But if you are going to do it, consider the approach of, okay, well, I've had this negative experience. How can I not do that again? And that's when you layer on rules. You start to develop and firm up the things that you want to do more of, and apply rules to eliminate the things that you want to do less of. So that's the approach that I took. So you've got to document these things. You should keep a diary, keep a journal. I would urge you to physically write it down. There's nothing quite like pen and paper. And analyze and review your trades, analyze and review your day. I was more day trading back then. So at the end of the day, I could review, hey, these were good trades, these were not so good trades, not necessarily because of the money I made or lost. It was just like, okay, well, I had this horrible emotional reaction to this trade. Why? And just take this Socratic approach. Again, I love my quote from Socrates. You've got to learn. There we go. So it's better to change an opinion than persist in a wrong one. So that's what we're trying to do. You don't want to continue with the negative behavior. You want to kind of make that change and take that Socratic approach of, okay, well, I had this experience, why? And try and analyze it. Again, this was the approach that I did. So if you're going to DIY it, that's the best approach to try and get to the end results. Have a curious mind and be prepared to change. It's hard work what we do. It's not difficult. As I keep saying, I've given you my process. The hard part is doing it and sticking with it and having a shitty trade and then putting the trade on again tomorrow and the day after and the day after that. You're going to have good times. You're going to have periods of bad times, just like any other business. But you've got to follow and apply positive behavior. And that was the approach that I took. So you've got to change so that you get the results that you want to get. As I promised you at the beginning, if you would like to work more closely with me, let's talk. I don't know if what I do is right for you. As I keep saying, I do not know if what I do is right for you. But if you want to work more closely with me, just go to my website, AntiVestor.com. If you're watching this on your mobile, and you can't write that down, go to productionlinetrading.com. That will redirect you to my main website. So productionlinetrading.com. And again, just read the information there, follow the process. If you want to reach out to me, hit reply on any of the emails that you receive from me. I'm very open to try and help you find what you want for trading. I'm not naive enough to think that what I do is the only way of doing it. I will always point you off in the right direction if what I do is not going to be suitable for what your requirements are. So you're always left with two choices. You can do it the old way. You can keep flapping around trying to Frankenstein a profitable trading system together before it's too late to make a difference. Or you can press the easy button and plug into a tried and tested system that I've developed over the last 30 years. I've spent thousands trying to develop software to assist you. We've nailed it. It's coded up. If you wanted to just wait for the little arrows to appear on the charts, you can do. I still like to reveal what's behind the curtain so you'll know how those arrows that you see on my charts and strategy reports are created so that you can get your own results, just like Kyle, Colin, Tony, Randall. You're not here today, mates. I know you're watching the replay. Stephen, Emily, Bal, we've got Yannick. Again, all the people that get results. Again, obviously I get my own results. The broker statements are on the charts, but we get results because what we do works. Again, I'm very pleased with this. It's a long, hard journey to get here, but you don't have to reinvent the wheel. You can just plug into a process that is proven to work. Right, folks, that's it. Thank you all for your time and attention. Brett, thank you for your comments. Really appreciate getting involved. As always, just one final thought. Thank you for your time. Thank you for your attention. I appreciate that we could all be doing other things with our time. The day job, spend it with loved ones. I just want to thank each and every one of you for deciding to spend it with me here today. If you need anything, I'm very open and accessible. As I mentioned earlier, just hit reply on any of the emails that you receive from me, and you'll typically get a reasonable response as soon as I see it. But for now, just do it. You've got the process. Go and put it into action and go and profit handsomely from it. And until next time, I will speak to you soon. Have a wonderful weekend.